When headlines become alarmist, I find it helpful to pause and take stock of what we really know about the bond market. First, it is finally offering something we haven't seen in a while: a meaningful premium for lending over longer time periods. You can earn mid-single-digit returns in government bonds compared to just over 2% in cash. Second, markets expect little change in monetary policy of main central banks for the next year or two. And frankly, I think that's unrealistic. With the massive investments being made in AI and ongoing disruptions to global trade, we should know a lot more about where things are heading well before then. Third, bond investors are wary of government debt. Why? Because economies are growing at a decent pace, governments are running large deficits, and we have just lived through a significant inflation surge. Investors are rightly demanding better compensation. That's why yield curves have steepened globally. This makes it tough for central banks to justify cutting rates further. So our view is straightforward. Don't expect much in the way of capital gains from bonds over the next year. Bonds should deliver returns modestly above cash thanks to those steeper yield curves, and absent a significant economic downturn, that's the realistic picture. Where we see value? Important to note that not all bonds are created equal. Aside from the US, many markets outside of Canada offer higher yields on a currency hedged basis, which is why we are recommending overweight positions in non-Canadian bonds. And here is a call that might surprise you. We are overweight Japanese government bonds. I know. Japan used to be the cautionary tale about fiscal risk. But Japan's actually got its fiscal house in order better than the US, UK, or France now. Their budget deficit is lower. Yes, they have high gross debt, but they also have the largest net international investment position in the G7. The market is compensating investors handsomely for risks that we think are overstated. We also continue to recommend holding more investment-grade corporate bonds. Corporate balance sheets remain strong. In fact, corporate debt burdens have declined since the financial crisis, while sovereign debt has ballooned. Credit spreads are tight, sure, but all-in yields still look attractive, and we see any widening as gradual rather than sudden. To wrap up, we're living with plenty of known unknowns. Geopolitical risks, old and new, like the war with Iran, policy uncertainty, all these things could materially impact markets. But we are also grounded in what we know. Inflation is normalizing, economies are resilient, and bonds are finally offering reasonable compensation for term risk. That's why we're focused on building resilient portfolios that can weather markets grappling with unwelcome surprises, putting us in a position to add risk when the compensation for taking it will be generous.